In today's video, I'm going to be analyzing President Biden's tax proposal. Now, there are a lot of things in this tax proposal: business tax changes, international law changes, housing, energy. I'm going to focus primarily on the things that mostly impact you. The first thing is raising corporate tax rate from 21% to 28%. Now, you might think that it's not actually going to impact you much, but that's not true. There is a lot of research done on the impact of increased corporate tax rate on growth and economy. For example, here we have an article that says that reducing corporate income tax actually increases annual growth. Here we have a study with 15 different countries, and it says that 1% tax increase actually reduces GDP by 1.3% after 2 years. Another study that says reducing corporate income tax rates actually raises annual growth. So raising corporate income tax rates would actually impact the growth of the country. So that can mean lower wages. That can mean companies taking their headquarters and going elsewhere. Now, the next proposal is to apply the net investment income tax to pass-through entities. Currently, individuals with a modified adjusted gross income of $200,000 for single or $250,000 for married filing jointly pay a 3.8% net investment income tax on things like interest, dividends, capital gains. Now, the proposal would actually expand the net investment income tax to ensure that all pass-through business income of high-income taxpayers is subject to net investment income tax. So what does this mean? It basically means that if you are in a business through a partnership or even S corporations, as many small business owners are, you would pay a 3.8% tax on the income derived from S corporations or income derived from partnerships. Now, this only applies for people making $400,000 or more. Now, nearly 50% of small business owners are actually S corporations, so this would impact a lot of people. The next proposal is to increase the net investment income tax and additional Medicare tax on high-income taxpayers. Individuals are subject to a 3.8% tax on net investment income. In addition, there is a 0.9% Medicare tax on people who are making more than $200,000. Now, the proposal would increase the additional Medicare tax rate by 1.2%. So that will bring the total Medicare to 5%. And the proposal would also increase the net investment income tax by 1.2%, also bringing it to 5%. Now, it seems to me that they're heavily increasing tax for high income taxpayers. It almost seems to me as they don't want to incentivize people to make more money and basically stay below the 400,000 barrier. The next proposal is a pretty big one. It had a lot of media discussion, and that is to reform the taxation of capital income. So currently, if you have a long-term capital gain by selling stock or ETF, or if you received a qualified dividend, you would pay between 0 to 20% in tax depending on your income. In addition, if you are making more than $200,000 or $250,000 if married, you'll also be subject to what we talked before, a net investment income tax. So that brings the total to 23.8%. The proposal say that long-term capital gains and qualified dividends of taxpayers with a taxable income of $1 million would be taxed at ordinary rates, with 37% being the highest. So we are going from 20% being the highest to 37%. In addition, there is a proposal to increase from 37 to 39.6, and then when you add that 3.8 net investment income tax, or 5%, as they also want to increase that will put at 49.6% capital gains tax. You might say, well, this only actually applies if someone makes more than $1 million in a year. I'll show you why this actually impacts a lot of people. So for example, I found this home in Santa Monica, California, that's selling for about $1.6 million. If we scroll down to the history of the home, we can see that it was sold in 1994 for $337,000. If they sell this home for 1.6 minus 337, it'll be about 1.3 million of capital gains. You are able to exclude 250,000 or $500,000 if you're married. So let's say this is a single taxpayer, they will be able to exclude it. They will still have about $1 million of taxable income. That proposal would apply to them. So before they would pay 23% tax, and now it will increase to 39, or the total total would bring it to like 44%, right? So it definitely impacts a lot of people. The next proposal is to limit rollovers and conversions to Roth accounts. High income earners are not able to contribute to Roth IRA directly. There is a strategy called backdoor Roth strategy that allows you to indirectly contribute to Roth IRA. Now, this provision would actually prohibit these types of rollovers. So it says it would prohibit rollovers or transfers of amounts that are not held within a Roth account into a Roth account for a high income taxpayer. Now, honestly, I don't really understand this specific one. I know many people who are making a lot of money, yet they're not even saving for retirement. So at the end of the day, it's not how much you make, but how much you keep. Next proposal is actually pretty interesting. It says provide tax credits for certain first-time home buyers and home sellers. So currently, there is no specific tax credit to support home purchases by first-time home buyers. There are certain programs by specific states, but nothing from the IRS standpoint. So the proposals would provide two refundable tax credits, a credit for qualified first-time home buyer and a credit for a qualified home seller. The home buyer credit would be equal to 10% of the purchase price of a home up to a maximum credit of $10,000. Now the credit would phase out with income of $100,000 and ending at $200,000. Basically means if you're making half of that or you're making $150,000, you would get half of the credit or $5,000. And if you're making more than $200,000, the credit would not apply to you. Now, there are specific things to meet in order to qualify. For example, you're a first-time home buyer and you cannot be claimed as dependent. What's interesting is that it says if you dispose that home within the next 3 years, you would have to give that credit back in its entirety. Now, there is a home seller credit as well for a maximum of $10,000. It's basically mimicking the homeowner credit, though same income limits, $100,000, $200,000 maximum. You need to sell a home to an unrelated party. Actually, during 2008 recession, there was also a home buyer credit. I found an article that says what are the impacts of home buyers tax credit on housing and economy. The study looked at the Economic Recovery Act of 2008, where they were providing a $7,500 credit in 2009. If we scroll down and look at the conclusion, it says that the IRS paid roughly $26 billion in 2009 and 2010, since this credit is about 25% more. Plus, it would apply to home sellers as well, not just home buyers. I would expect it to cost roughly $100 billion. The results of this paper suggest that while the home buyer tax credit was expensive and it did not have a significant positive impact on the price and quantity of homes sold, it did have a large and positive impact on the length of time it takes to sell a home, income, and GDP, which also helped stabilize the housing market. Since currently we have an issue with the inventory, it's interesting that they also added the home seller credit. Now, I'm worried about the price of homes. Now, the study did say that it did not have a large impact on price, but since we will have a home buyer and home seller credit, I wonder if that will still apply. And ultimately, the IRS needs to find a way to finance the $100 billion of tax incentives. Again, we would be able to expect increases in other areas to finance this one. Now, the home seller credit definitely addresses lack of supply within the current housing market, so that will be very interesting to observe. The next proposal is to repeal deferral of like-kind exchanges. So currently, owners of real estate are able to exchange one property to another and defer the capital gains on the property. The proposal would allow a deferral of gain up to $500,000 for each taxpayer or $1 million for married individuals for every single year. If there is more than $500,000 gain or more than $1 million, you would be subject to tax. Like-kind exchanges is definitely a very heavily debated topic. Now, some people say we shouldn't have like-kind exchanges. Others say that they're extremely necessary for the economy. So now I wanted to find a study, and there's one, the tax and economic impacts of Section 1031, like-kind exchanges in real estate. Now, what's interesting from this study is that it says that the median sale price of a property involved in exchange is approximately $575,000. This shows that the 1031 exchanges are not primarily used by corporations. The study concluded that in absence of exchanges, investors would delay disposing their property. So that's if the 1031 was repealed. The removal of exchanges would lead to decrease in investment. And the decrease in investment can have a big macroeconomic impact as well. For example, the decreased construction and investment activity will depress employment in sectors and markets where like-kind exchanges are commonly used. The last one is not that impactful, but I thought that was a pretty interesting one, is to make repeated failure to file a tax return a felony. Currently, if you fail to file a tax return, it's a misdemeanor and punishable by imprisonment of not more than 1 year. The proposal would amend Section 7203 to increase criminal penalties for high-income people with high tax liability. The offense would be classified as a felony punishable by imprisonment of not more than 5 years. Make sure you file your tax returns. All of these proposals, they haven't been passed yet. I estimate that maybe roughly 10 to 20% will get approved, but certainly not all of them. In addition, it will depend who is controlling the president's seat. But regardless who is controlling it, there will be changes coming to the tax law. So make sure to subscribe, hit that like button, and I'll make sure to keep you posted on any upcoming tax changes.